I believe we're in an environment in which we're creating a lot of debt and money, and the money as we know it, and financial assets such as debt assets, which is just a commitment to receive a lot of money. I think we're in an environment that's not going to be a good environment, and people will want to look for alternative storeholds of wealth. We're now seeing a type of conflict that we never saw before.
In today's video, Ray Dalio, the founder of the world's biggest hedge fund, Bridgewater Associates, talks about the financial system and its working, money and the Fed. Dalio explains how he sees the world right now and elaborates on the macroeconomic picture. Before listening to him, please ensure to smash the like button and subscribe to the channel.
How are you cutting through that noise and trying to figure out, for example, the big question of, is this a place that's becoming less open to free market principles, or do they just have an idiosyncratic or unique approach to free markets? I don't know if I'm articulating that well, but how do you...
No, you're articulating it well, and I can answer your question. First of all, I should say that I start with a real humility in operating and saying, I don't know if I'm wrong or not. And I don't like to go into areas that, I'm no expert in, except if and in case of China, it's a particular case. I've been going there since 1984. I have contact with, the highest ranking, most immersed people, Chinese and non-Chinese. And then I triangulate, I speak with, I won't name them all, but, this one or that, and they are immersed in it, and I get the triangulation, and that leads me to whatever my conclusions are, and then I don't invest more than an amount of money that I can be comfortable getting whacked with. So I diversify. I become highly informed through the triangulation, through the expertise that I've developed. If it was a place that I didn't develop much expertise in, it would be that I would be driven to have a certain amount of understanding, and I would also know, who are the really not only smart, but straightforward, honest people of good character who will not BS me, and so on. And it'll be that curiosity and the debate between them that will help guide me. And then I'll tread gently in that direction by putting not too much in, not too little. So it goes back to this 15, I want 15 good uncorrelated investments, return streams. So that's how I would do it. And how I do it.
So you're setting yourself up so you're aware that you could be wrong, and you're making sure that your errors won't be fatal if you're wrong.
That's right. Right. And have the best insight, because in China, it's because I know it very, very well with the right people, right? I mean, that's key. There's so many people who are not as fortunate as I am to have those exposures, but then they still have to do theirs, and then they have to do the triangulations. So it's that, but even though all of that's the case, there are the great uncertainties. What if we go to a type of economic war, or worse, a military war, or all of these things? In every place, in every location, in every investment, in almost every decision practically, there's a probability of being wrong. And painfully wrong. And so, like I say, if I have 15 good uncorrelated bets, I will reduce my risk by 80% without reducing my return. And that means I improve my return to risk ratio by a factor of 5. So yes, it's like a casino, Yeah, when the casino's playing and they have so many tables and so on, many things going on, it's not any one of them on any one night. It's all that diversification and that, consistency. What I mean is, it's like a poker. Somebody's going to take money away from somebody else in terms of that zero sum. And it's more difficult for to compete in than the Olympics. It's more rewarding, more people change it. You wouldn't say, I'm going to go compete in the Olympics. It's very difficult to compete in the markets. So I would say the humility should be very high. That means the diversification also should be very high. And then, we could spend a lot of time on what type of diversification you need. It's particularly almost easy to do in the markets because the markets almost make all the bets more equal than you would imagine, because it's like betting in a horse race. And then what happens is there are faster horses and there are slower horses, but the odds are adjusted for that. So you can be equally likely to bet on the least likely horse to win, and it'll have the same expected value as betting on the most likely horse because of the way that they're handicapped. And the same thing exists in the markets. It's almost like the markets will make them more equal in terms of that edge. So what it means is that that diversification is important. Now, what do you diversify? You have to understand a little bit about what makes markets move together and not. I don't think you want me to digress into that, but you can see, you can just even look at how things have changed over time. But it's something that we're not going to be able to cover, here now because it's just too lengthy. But yes, and you could go back and you could see, ask whoever you're asking about the investments, go back and take them to the year 2000, each one of them. I go back to 1900, but maybe it's not so easy for you to go back to 1900. But if you take that investment and you see how the one did, and then you see how they did in relationship to the other, and you go through 2008, or you go through this period recently, you could see how they performed and how they performed in relationship to each other and how the diversification would have worked. So those are the things that should be done, I think.
So broadly speaking, you'd want, so let's say a regular investor has, a Vanguard index fund that has, the total stock market or the S&P 500 or something, and they have an international index fund or something like that. And then you'd also want to have some inflation index bonds, some cash.
That's right.
Like gold.
Right. Yeah, and they're all like return streams, I call them. You plot them and they go up like this and so on, and you do that. So now you look at the one over a period of time, knowing that the future might be different from the other, but looking at how they move in relationship to each other. And then you say, okay, if I put this one with this one and so on, and they match it. Now, I could explain more about financial engineering because there are some twists there, like how do you risk balance them? Some have more risk than others. By raw risk, I mean volatility. For example, the stock market is more than twice as volatile as the bond market, depending on what part of the bond market, what stock, but roughly twice volatility. So if you put 50% of your money in each, it'll still be dominated by the stocks. So how you find the right bonds, longer duration bonds will have greater volatility or whatever. You put those things together in a way where you see how they balance each other so that they provide that diversification. I can't tell you how many times in my 50 years, the exact same things happened. So you kind of know, you smell them, they have that smell to them. But I would say the best thing you could do is go back in history and see the other cases, almost imagine, like everything's another one of those, So I go back to that case and I think, there was the Nifty 50, there was the dot-com bubble, there was the real estate bubble, there's so many of them. And I have criteria to identify them, but that's me as a professional doing that kind of research to have criteria. The markets reflect the opinions. So for that reason, when everybody agrees on something, they're probably expensive. And when everything is hated and you think it's the worst, everybody, then it's probably cheap. And people confuse the fact that, let's say, a good company is not a better investment than a bad company, any more than the horse in the horse race that the worst performing horse has odds that are much higher if he comes in. And so because of that, you have to know what to look for in those things. But I don't think that I think you have to be careful about that and diversify well, and beware of fads, But if you diversify well, it'll be easier and better, because it's very difficult also to distinguish a fad from a new reality. Is crypto a new reality or is it a fad? Is this technology thing, a new reality or a fad? Those can be difficult to decide. So, go back to the diversification.
And have you updated your view on crypto now that many of these...
Well, yes, but I think I'd rather not I can get into it, but we want to talk about the life cycle and the other parts of the book, I think, because I want to help people with their principles. I mean, but everybody's interested in crypto and but I don't know that we should. Do you think we should digress into that?
Can you give us, I think people will be so curious. I think it's worth giving a sort of 2 or 3 sentence synopsis of a brief view of whether you think there's anything there, or whether you've kind of come to think, no, I don't think there's much there.
Well, there's a technology, the blockchain technology, which I think is an excellent technology. And I think it's very important to distinguish it from a digital currency. And if we're dealing with digital currencies, let's use Bitcoin as an example. There are all sorts of things. There's stablecoin and blah, 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 all sorts of things. But by and large, let's talk about Bitcoin. Now, first of all, I believe we're in an environment in which we're creating a lot of debt and money, and the money as we know it, and financial assets such as debt assets, which is just a commitment to receive a lot of money. I think we're in an environment that's not going to be a good environment, and people will want to look for alternative storeholds of wealth than those in alternative money. Having said that, like all the digital currencies, basically don't replicate anything. They move up and down for all. It's not like it's tied to it's an inflation hedge or it's this and that. It's mostly, so it's not an effective storehold of wealth. You almost have nothing to hang your hat on, and it's tiny. Bitcoin right now probably has a total value of maybe a quarter of what Microsoft stock is, and so on. So it becomes a preoccupation by people that is disproportionate with its true reality. I mean, why study that? There's so many things, so many different investments that you can study. And it's as a storehold of wealth, there's not privacy to it. There may be privacy from the public, but it's very easy. Everybody's tracking what you're doing on it and so on. So it's not private. And as a medium of exchange, it's not very effective. It's not like you can go there and easily buy stuff with it. You can buy some stuff with it, but not much. So it wouldn't be my favorite storehold of wealth. I mean, I own a tiny bit of it just because of the element of, who knows, and it could be there, but I'm not, and also to experience what it's like. But I do think that in time, there will be better digital currencies. Like I believe that you can create a digital currency that will give you the equivalent of the inflation rate. And that's buying power. Because I believe that most currencies are most debt instruments, which are, as I say, they're a promise to receive currency over the duration of them. I think that they will have poor returns relative to inflation, where I think you could get something that'll be a good digital currency, but they don't have it now. And so many things have sort of come and gone as fads, NFTs and, this coin and that coin and so on. So anyway, that's what I think about it. But again, I don't want them to tactically make the decisions because things become cheaper at the same time. So cautious means just constantly diversify well. But yeah, one of the things that I've learned is that many things that have surprised me because they never happened in my lifetime before, but they happened many times in history. It's just like a pandemic or a big debt crisis. What happened in 2008 was the same thing that happened, in 1933. And so the three things that are happening now that prompted me to do the research, which is in the book, Principles for Dealing with the Changing World Order, were the amount of debt and money creation and its effect on currencies and effect on the world and the value of money and all of that. So I needed to study that going back a long time. The second is the amount of internal conflict. We have the largest wealth and values differences. This is all measured. It shows up in the book or the videos. You can see the gaps. Largest wealth and values, and then political differences that is causing these conflicts. So the worst internal conflicts, politically, socially, and all of those. And then number three is this is the first time in my lifetime, most of our lifetimes, therefore, that we have a great power conflict where, the world order that we started was in 1945, just like they always do. There's a war, they're winners of the war. Somebody comes out of it rich, somebody comes out of it poor. And then we set the American world order in 1945. The United States accounted for half of the world's GDP. It had 80% of the world's money. The money was gold at the time. It had a monopoly on military power. And so then you see that change. And so we're now seeing a type of conflict that we never saw before. Soviet Union was never an economic power, it was just a military power with nuclear weapons. So it was never. And so we're seeing that great power conflict. Those three things led me to want to study history and to watch the rises and declines, because I knew the same things happened basically in the 1930 to 45 period, but I wanted to go back. So I went back 500 years and I studied it to see the same things happen over again.